Welcome back, everyone. If you thought this week was just another rough week for the markets, think again, because what just happened might be one of the most shocking corporate scandals in the AI boom. On Friday, Supermicro, a $2.5 billion AI infrastructure giant, collapsed more than 30% in a single day. Why?
Because the US Department of Justice just indicted 3 individuals, including the company's own co-founder and board member, YK Liao, for allegedly smuggling restricted NVIDIA AI chips into China. We're talking about $2.5 billion worth of advanced GPUs, including the cutting-edge Blackwell B200 chips. According to prosecutors, the scheme involved Southeast Asian shell companies, fake servers used as decoys, and even hairdryers to peel off serial number stickers to disguise the chips. Yes, it literally sounds like something out of a spy movie. But the SMCI scandal wasn't the only shock this week. At the same time, the global oil supply was nearly choked off. The Federal Reserve just killed expectations for 2026 rate cuts, and the S&P 500 recorded its 4th straight week of losses. This wasn't just volatility, this was a perfect financial storm. So today we're breaking down the SMCI scandal shaking the AI sector, the Middle East energy crisis threatening global supply, the Federal Reserve's hawkish shift, and why even gold, the ultimate safe haven, just had its worst week in a year. Let's break it all down. Let's start with the story that shocked Wall Street the most. The US Department of Justice announced criminal charges related to an alleged scheme to bypass US export restrictions on advanced AI chips. The indictment claims that executives connected to Supermicro helped route restricted NVIDIA GPUs through a Southeast Asian shell company before sending them into China. These weren't ordinary chips. They included high-performance AI processors designed for advanced computing and AI training, the kind of hardware the US government has been trying to keep out of China. And the alleged methods were astonishing. Investigators claim the group used hairdryers to remove serial number stickers, replaced them with altered labels, and set up decoy servers to trick US compliance inspections. If these allegations hold up in court, the consequences could be enormous. SMCI could face massive regulatory fines, criminal liability, and possibly losing access to NVIDIA GPU allocations altogether. That would be devastating for their business. Wall Street immediately started pricing in that risk, as SMCI shares collapsed more than 30% in a single trading session. Meanwhile, rival server maker Dell rallied, as investors expect it could absorb SMCI's AI infrastructure orders. But while the tech sector was dealing with scandal, the global energy market was facing something even more dangerous. A geopolitical crisis in the Middle East threatened one of the most critical energy choke points in the world, the Strait of Hormuz. At one point this week, maritime tracking data showed almost 0 oil shipments passing through the strait for a 24-hour period. That's extraordinary. Roughly 20% of the world's oil supply normally moves through that narrow channel. Then tensions escalated further. Israel reportedly struck Iran's massive South Pass gas field, one of the largest natural gas reserves on Earth. Iran responded by targeting Qatar's Ras Laffan industrial complex, damaging infrastructure tied to the world's largest LNG export facilities. According to analysts at JP Morgan, the combined disruptions could remove as much as 12 million barrels per day from global supply. And yet, despite war risks rising, gold and silver crashed. Gold fell nearly 10% for the week, while silver dropped more than 14%. Why? Because when markets panic, institutions don't sell what they want, they sell what they can. Massive hedge funds and sovereign wealth funds facing margin calls had to liquidate their most liquid assets, including gold, to raise cash. Right now, the only real safe haven in the market is cash. The energy shock collided with another major catalyst this week, the Federal Reserve. On Wednesday, the Fed announced it would hold interest rates steady at 3.5% to 3.75%. But it wasn't the rate decision that shocked markets, it was the tone. Fed Chair Jerome Powell made it clear, if inflation remains sticky, rate cuts are not coming anytime soon. In fact, Powell even acknowledged that rate hikes could still be back on the table if inflation accelerates again. The bond market reacted immediately. The 2-year Treasury yield surged to 3.9%, pushing above the Fed funds ceiling. That's a huge signal. It means bond traders have essentially eliminated expectations for rate cuts in 2026. Meanwhile, the 10-year yield spiked to 4.38%. Higher yields mean tighter financial conditions, and stocks hate that. This week also featured one of the biggest tech events of the year. NVIDIA's GTC conference, CEO Jensen Huang unveiled new AI chips including Rubin Ultra and LPU inference processors, projecting that global data center spending could reach $1 trillion by 2027. He even floated the idea of building AI data centers in space using solar energy. That concept briefly sent Rocket Lab stock up more than 10%, but the rally didn't last. Rocket Lab immediately announced a $1 billion stock offering, diluting shareholders and sending the stock back down. Meanwhile, Nvidia itself experienced a classic sell the news reaction. High-frequency trading algorithms pushed the stock sharply higher after the announcements, only for institutional investors to unload shares into the rally. Despite incredible AI demand, the reality is simple. In a high-interest rate environment, growth stocks struggle to justify extreme valuations. So where does that leave the market? Right now, the entire financial system is dealing with three major pressures: geopolitical energy risk, higher for longer interest rates, and declining liquidity. This is no longer the easy buy the dip market of the last few years. It's becoming a preserve capital market. Next week, the economic calendar is relatively light, with S&P PMI data and Michigan consumer sentiment. But the real focus will be technical levels. The S&P 500 around 6,500 and QQQ around 595. If those break, we could see another sharp leg lower. For now, staying cautious and keeping cash ready may be the smartest move. Thanks for watching, and I'll see you in the next market update.